shares of NIO in focus here as we've got a new listing in Singapore.
And shares of Chinese EV maker NIO, they are moving lower here today by about 4%.
NIO is in a very, very hyper-competitive market here in China.
Seeing NIO having a challenge to deliver more vehicles and ramp up production.
It took Tesla 16 years to become profitable. How long is it going to take NIO?
I'm sure that we don't need over a decade to make profit.
NIO has been one of the more dramatic stocks to follow in the EV space. At its peak in 2021, shares traded above $60. By 2024, the stock had fallen back below $4 and the company was burning through roughly $2 billion a year with few signs of improvement. So when NIO issued a profit alert in early February 2026, forecasting what would be its first ever adjusted operating profit, it understandably caught some attention. Social media and finance forums quickly filled with talk of a massive reversal and institutional front-running. But before we start treating a single quarterly forecast as a thesis-changing event, it's worth taking a step back and asking, what's actually changed here? What hasn't? And what would a rational investor need to see before drawing any real conclusions? That's what we're going to work through today. NIO was founded in 2014 by William Li, a serial entrepreneur who attracted early comparisons to Elon Musk, partly because of his ambition, and partly because of how close the company came to collapse. By 2019, NIO was burning through over $1.6 billion a year, and its cash reserves had fallen to around $123 million. That's a precarious position for any company, let alone one trying to scale a capital-intensive manufacturing operation. Li was publicly described in Chinese media as the unluckiest person in China. What saved NIO was a state-backed bailout from the city of Hefei in 2020. Roughly $1 billion in exchange for establishing NIO's headquarters there. That lifeline, combined with a broader EV market rally, sent the stock from $1.19 to a peak of around 66.6, a 4,500% run in under 2 years. Then came the second collapse. Between 2022 and 2025, a brutal price war in China's EV market, driven largely by BYD's aggressive discounting, eroded NIO's margins. A $116 billion equity offering diluted existing shareholders, and the stock fell back below $4. So the question for 2026 isn't just, is NIO recovering? It's, is this recovery structurally different from the last one? Or is it another rally built on optimism that the fundamentals don't yet support? One of the most frequently cited reasons to be bullish on NIO is its battery swap network, and it's worth spending a minute on this because it's both genuinely interesting and frequently overstated. Here's how it works. Instead of waiting 30 to 40 minutes at a fast charger, NIO drivers can pull into a swap station and have their depleted battery replaced with a fully charged one in roughly 90 seconds, with the Gen 5 stations rolling out in 2026. That's a real and meaningful difference in user experience. There's also a financial angle to it. Because the battery is sold separately from the car, or leased to the customer, NIO can advertise a lower sticker price. For certain models, this undercuts comparable EVs by a meaningful margin, which matters in a market where price sensitivity is high. NIO hit 100 million total battery swaps in February 2026. That's a legitimate milestone, and it speaks to actual customer usage rather than just theoretical capacity. But here's where some of the commentary gets ahead of itself. NIO frames the swap network as an unassailable competitive moat. The reality is more nuanced. Building and maintaining a swap network is expensive. It requires physical real estate, hardware investment, and ongoing maintenance. Costs that don't disappear just because the technology works. On February 5, 2026, NIO guided for an adjusted operating profit of up to $172 million for Q4 2025. This is being described in some circles as the death of the bear thesis. Let's think about that for a moment. A single quarter of projected adjusted operating profit after 11 years of losses is meaningful, but it's one data point. Adjusted figures often exclude stock-based compensation and other real costs. The question is whether Q4 2025 represents a genuine inflection or a quarter that benefited from favorable timing, lower raw material costs, or a product cycle that may not repeat. That said, it's not nothing. If NIO can sustain or grow profitability over the next 2 to 3 quarters, that does change the valuation conversation materially. It just hasn't done that yet. NIO is no longer a single-brand company. In January 2026, total deliveries across its brands grew 96% year-over-year. Two sub-brands are driving that. Onvo is targeting the family SUV segment, a much larger addressable market than NIO's original premium positioning. Firefly is going after compact luxury buyers in Europe and China. This is a legitimate strategic shift. Expanding into higher volume, lower price point segments could diversify revenue and reduce NIO's dependence on its premium niche. But it also introduces execution risk. Running multiple brands requires separate marketing, dealership relationships, and supply chains. Whether NIO can do this profitably, rather than just at volume, remains to be seen. CYVN Holdings, backed by the Abu Dhabi sovereign wealth ecosystem, consolidated its position to 17.9% of NIO's shares under a state-owned fund called Limad. Some commentators are treating this as a floor, the idea being that a sovereign backer won't let the stock go to zero. That's partly true, and partly wishful thinking. Sovereign funds take losses too. Their involvement signals confidence, but it's not a guarantee of returns for retail shareholders. What it does do is reduce the probability of a catastrophic near-term funding crisis, which is worth something, given NIO's history. One of the more useful observations in the current EV conversation is that the China EV category has fractured. Treating it as a single trade is probably a mistake. Li Auto was widely considered the safer bet, profitable for 11 consecutive quarters. But January 2026 deliveries dropped 7.5% year-over-year, and JP Morgan downgraded the stock to underweight. Their hybrid strategy, which served them well during EV infrastructure build-out, may be losing relevance as pure EV adoption accelerates. BYD is the volume story, the world's largest EV maker by deliveries, but scale creates its own vulnerabilities. BYD has become the primary target for global tariffs and trade disputes, and a $60 billion market cap decline in early 2026 reflects how exposed large exporters are to geopolitical risk. XPeng sits in an interesting position: 126% delivery growth and industry-leading software capabilities. If autonomous driving becomes a genuine differentiator rather than a marketing claim, XPeng is arguably better positioned than NIO on that dimension. NIO's differentiation, the swap network, the premium positioning, and now the multi-brand expansion gives it a distinct identity in a crowded market. Whether that identity translates to durable competitive advantage is what the next few quarters of financial results will tell us. There are approximately 156 million shares of NIO currently sold short. Some commentators are treating this as a bullish signal, the idea being that if the stock holds above certain price levels, short sellers will be forced to buy back shares quickly, creating upward pressure in what's known as a short squeeze. This is worth explaining clearly, because it gets misrepresented a lot. A short squeeze is a real phenomenon. If enough short sellers close their positions simultaneously because the stock is moving against them, buying pressure can push a stock up sharply and quickly. GameStop in 2021 is the most famous recent example. But here's what a short squeeze is not. It's not a thesis. It's a potential price catalyst that has nothing to do with whether the underlying business is actually worth more money. A stock that squeezes can fall right back once the mechanical buying pressure subsides, particularly if the fundamentals don't support the higher price. The short interest is worth noting as context. It is not by itself a reason to buy the stock. Let's be specific about what the bull case for NIO actually requires, because vague optimism isn't an investment thesis. First, the Q4 2025 adjusted operating profit needs to be followed by at least 2 more quarters of sustained or improving profitability. 1 quarter proves a company can hit a number. 3 quarters starts to suggest a trend. Second, Onvo and Firefly need to deliver margin-positive growth, not just volume. High delivery numbers that come with high losses aren't a sign of health. They're a sign of growth being subsidized by capital markets. Third, the Gen 5 swap station rollout needs to proceed on schedule. Any meaningful delay there removes one of NIO's core competitive arguments in the near term. And fourth, and this one is easy to overlook, NIO still operates in a market where BYD is actively pricing to win. The macro environment for Chinese EV makers hasn't fundamentally changed. A company can do everything right internally and still face headwinds from a competitor willing to compress margins across the entire industry. NIO, in early 2026, is a more interesting company than it was a year ago. The profit alert is real. The delivery growth is real. The sovereign backing reduces some of the existential risk that made the stock genuinely difficult to underwrite in 2024. If you're invested in NIO or considering it, the next 2 quarters of financial results will be far more informative than any single profit alert or milestone announcement. Watch the actual numbers, not the narrative around them. As always, this isn't financial advice. It's an attempt to think through a complicated situation with a bit more rigor than the average headline. Do your own research, and be skeptical of anyone who tells you a complicated story has a simple ending. And for now, thank you for watching. If you found this breakdown of the February profit alert and the battery swapping moat helpful in navigating the noise, I'd certainly appreciate it if you liked the video and subscribed to the channel.